Zach here, and I wanted to take a minute and I wanted to make a video regarding this NAR lawsuit, National Association of Realtor lawsuit, where the buyer's agent commission now needs to be negotiated in advance. And then run through a quick example of, how you structure the contract could affect the financing of the loan. So let me start with the two most common things I'm seeing financing. And the first one is this. For some reason, there seems to be a consensus out there that the buyers are going to be able to finance in the buyer's agent commission into the loan. And as of the time of this video, August 7th, that's not the case. The other thing I'm seeing out there is this assumption that seller's agents are just going to be able to offer seller concessions to pay for the buyer's agent commissions, and that is also not the case. Fannie Mae actually came out with some clarifying language regarding this, and they specifically said buyer's agent fees are not IPCs, which stands, that's interested party contributions, or seller concessions. You're not going to be able to use seller concessions to pay for those. And this has a significant effect on the potential financing of the loan. So in this hypothetical, we have a seller, and this is not including paying their agent, but let's say they want to net $500,000. We won't keep the number simple. You've got the buyer's agent who has a contract written up with the buyer for 3%, and then closing costs of approximately 2%. So this is a fairly common example of a situation that could occur. I want to show you five ways to structure this contract, and in each one of these five, the seller gets the same amount, $500,000. Let's start with the buyer's going to pay the comp, okay? Buyer needs to come up with 5% to pay the buyer's agent and the closing costs, plus the 5% down that they need. Their loan to value is 95%, but they need 50 grand or 10% to actually close on this deal. Now, if the seller or seller's agents, they want to help out the buyer and offer some concessions, they can do that. The max concession when the LTV is 90%, 95% is 3%, right? This is a conventional loan in this example. So with 3% seller concessions, that's $15,000. The seller's concessions need to be used for closing costs and prepaids, which we've determined to be 2% in this case. They can't go to the 3% that the buyer's paying. So the extra $5,000 or 1% left over has to go towards buying down the interest rate. If the seller pays the buyer's comp and doesn't offer concessions, the borrower is going to have a lot less cash to close. They still can take the extra money and buy down the rate if they decided to do that, because they're bringing less cash to close. They could still bring $40,750 and buy down the rate, in this example, to 6.25%, but they don't have to, and that's the point. So they have some options here. And in most cases, first-time home buyers, the cash to close is a big part of the issue. The other thing that they could do is the seller can pay the buyer's comp and concessions, right? By doing that, of course, the purchase price would be higher, but in this case, all they're doing is they're putting down the 5%. What this does is it really helps to lower the cash required to buy a house, right? If you set it up this way, and the borrowers do have $50,000, they're pretty close to being able to put 10% down. And if they can put 10% down, they're going to have a lower payment. They're going to have lower mortgage insurance. So from a financing perspective, and this again, seller nets the same amount in all of these examples, the thing that offers the most option is for the seller to pay the buyer's comp and maybe even offer concessions if they're willing to do that. In my opinion, as a lender, everything should be set up this way. Now, it's true, the appraisal might come in low and you can adjust from there, but you should at least try to make the financing as beneficial for the buyer and as flexible as possible. And you do that by having the seller's agent or having the seller pay the closing costs and prepaids. In this example, and as we kind of get into this, I do expect to see these situations where the buyer's agent is being paid by the buyer. And I just want to do a little bit of a warning here. First of all, by seller agents, recommending this, you really are alienating a big potential portion of the buyer pool, because especially first-time home buyers who have the best rates and are out there searching for homes in a higher interest rate environment, they're not going to have as much down. Like, the cash to close is a bigger deal when you're first starting out. The second thing I would say is the buyer's agent commissions are not really associated with the loan. This is a contract that the buyer has with the agent outside of the loan process. So it is entirely possible that you could get a loan all the way to the closing table, and then when title adds in the buyer's agent commission, the buyer no longer has enough money to close the loan. And so far, I don't see that underwriters are actually requiring these buyer's contracts. I don't know if that's going to change going forward. You know, I can certainly see there being some issues at the end of the process when the buyers are having to pay their own commissions, and particularly if this is not something that the underwriter is looking at, which as of right now they're not. Anyway, that's my 2 cents. I don't honestly think that everyone's aware of the details of how this could affect the financing, how it actually plays out when this kicks in. We're gonna find out in the next 6 months or so, and I think that some lessons are going to be learned the hard way, and maybe they'll make some adjustments to the rules. But I wanted to get this out there because I don't see that people are talking about this too much, and I certainly see that there's a lot of bad info out there. So yeah, bring it on. See what happens.